Many of our senior people have been here for many, many years. And I think also notable is we've only had one person leave our team in the history of the product since I've been at the firm since 1994. So we're extremely proud of our tenure. But why is this important to you? It's important because when we go through crises, when we go through market cycles like this, especially as violent and as sudden as this one came upon us, we can reflect back to previous cycles, other downturns, other rebounds. And we can be effective immediately because of our tenure together, our experience together, and also, of course, our cross asset class research platform that we have, where we're looking at multiple parts of the capital structure all under one roof and one team. The universe, when we think about income and growth, that's critical to remember also is the diverse asset class performance. Now, we'll talk about this a little bit more further in the presentation, but convertibles, high yield, and equities combined to a participate and protect type of return profile. Income and growth through multiple market cycles now have provided that type of return for expectation purposes, but also in reality. So when we look at the overall return profile, we can think about a convertible bond. Convertible bonds participate with those equity market moves higher. And convertible bonds can protect and have that bond floor, that downside protection when equity markets go lower. So the entire convertible presence in the income and growth fund is actually representative of the entire profile of the fund. So it's also good to remember that point. It's incredible. None of us have seen this before in the speed and violence, and I use that term on purpose, of the nature in which the markets move down and then how it's also moved back up. So here we've represented on a slide, this is a total return only through May 29. And it's very important to know that this was a month-end number, and as we've moved into June, things have improved even more. So as we look at these asset class returns, we can only look back just a few short months ago that things look very dire. And the performance in the market was on a significant decline because of the vast uncertainty about the healthcare crisis, the incredible speed in which many, most individuals were quarantined. They had to stay home. They couldn't go to work. They couldn't buy goods and services the way they had in the past. And some industries were hit significantly. What we learned over now looking in the rearview mirror, and we don't have to look too far back, is there were certain industries and certain companies that actually performed better because of this new environment in which we all had to work in. Many remote locations required more cloud service, more remote computing, more software. There's a very long list, quite frankly, of those services that individuals needed to continue their normal lifestyle as well as their work environment. These are things that benefited us very quickly from a market return standpoint. So when we look at the large cap and small cap stocks and the significant rebound we've seen, there are several factors there that we're going to illustrate as we continue through this presentation. But all of the rebound is based on changes in the fundamental outlook. It isn't just technical in nature. There was tremendous uncertainty as the market declined, and as the market rebounded, there was significant certainty added back into elements of both company profitability, company liquidity, and the long-term outlook for the economy. So I'll pause there and just move ahead. There's, of course, positive returns across the board, and the least of which, of course, are now the 10-year yield, because there's very little to earn there. So let's look at the economic statistics briefly. We usually show these two slides, both on the U.S. economy from unemployment, consumer confidence, what is the ISM and manufacturing environment, from a certain perspective. And we talk about it every quarter and we update the slides. Well, this is a unique environment. This is completely different than anything we've looked at before. And we have a extremely important perspective just in the very first chart. Never in my career, and I don't believe Justin in yours either, have economists ever been more wrong than the US employment report that we had just a few short time ago. When we look at the employment report, most economists were expecting a significant continuation of layoffs, departures of employees, cost-cutting measures for the month of May. And what we saw was the exact opposite of that. And the reopening was happening faster than expected throughout the United States, and actually 2.5 million jobs were added. Why am I pausing on this? Because usually economic conditions is something that I wouldn't spend that much time on. We wouldn't usually present income and growth and focus on the economics, but in this particular environment, this is an outstanding figure because it's never been more incredibly disconnected with reality of what economists thought. So we certainly didn't know. We didn't have a pulse. We actually reside in California, which was somewhat behind many other states in the US, and when they were reopening. And I can tell you, as of now, things are reopening in even those states that hadn't reopened before. So we're seeing a significant snapback in all of those industries that were hit with the layoffs and downturns of those services that could not be used under quarantine. So when we look at restaurants, hotels, certainly airlines, autos, and the list goes on of those cyclical industries that were shut down to zero, many of those have not only restarted, they've already hired all their employees back to service the demand that is there. Because another fear was that US consumer, which is on this board as well, would have no interest in going back to restaurants and being very fearful of theme parks that might open up, or being fearful of going back to a retail store that they were going to be near someone. The opposite has happened. Many of those consumers are actually running right back to the stores. They're going back to restaurants, and we're seeing a very big snapback. So even more demand for hiring. We certainly expect the economic recovery to be pretty quick coming out of this, but we'll continue forward here. Retail sales. We know that retail sales from a storefront standpoint has been down, but you can look at many large companies that sell online and see that retail sales have been just fine from a remote location perspective, and people are buying things that they might not have in 2020. So I'll continue on past the economic point. We'll circle back to that again later in the presentation. Yields. Where is the opportunity today for investors to earn a monthly distribution, a monthly income where they might have an opportunity to pay off bills, meet expectations for their household? Where are those people going to invest today? And this has certainly been thematic and true for quite a long time, because especially when we look in many parts of the world like Europe, rates have been zero or even lower than zero versus what we've seen in the Americas or in Asia. But again, this crisis has caused new things to happen. And what has happened is yields have dropped globally, making it even that much harder in that search and that quest for yield. So when we look at Treasury curve and economic growth, we're in a period where we could say when there's an inversion in the 10-year Treasury and the short-end dated bonds, that is not constructive for economic growth. And we circled in red these times historically where we've been in a recession in the United States. And quite frankly, when yields started to invert towards the end of 19 and early 2000, due to a host of factors, the most notable of which is the absolute low rates, both in short bonds and long bonds, and that contraction was caused by many technical factors as well as just where was the opportunity for the economy to continue to improve, and things were actually pretty good anyway. But the curve wasn't steep. Would we see an economic downturn? Lo and behold, through a healthcare crisis, we received our economic recession. And many of the factors that happen in economic recessions were collapsed into a very short time frame because of what this global pandemic has caused. And I want to stress this point. We don't need to look forward to another recession because this has washed out many of those businesses that were on thin ice. They had either over-levered themselves, they had weaker businesses, they were companies that were struggling to get by. Most of those companies were impacted immediately, and the weaker companies are going away. The companies have already downsized and terminated employees. Cost reductions are significant. And those healthier companies have had immediate access to capital. So what am I summarizing here? Our opinion is that we have already seen the recession that will be caused by an inverted curve. We don't need to look forward into next year to think about when that might happen. We've already seen it. What is one of the primary catalysts? And I was excited to talk about this earlier in the presentation. I held off knowing this slide was going to come up. And when I say global, it's not all term federal, but the point is governments globally have gone over and above any previous market cycle and downturn to help boost every element of the economic situation for their own individual countries. And this on a combined basis has no historical precedent. So let's focus on the US. In the US, there's nearly $3 trillion of fiscal stimulus and federal incentives for companies, individuals, to both benefit themselves, get by from a, call it payroll protection policy, for unemployment, additional benefits, extended terms. All of these things help the individuals, but one of the most impactful for the Income and Growth Fund was when the Fed came forward and said that they would buy individual corporate bonds and ETFs. That is unprecedented. We have not seen that before. In addition to all the TALF and everything else that was happening in 2008, when it came to this particular cycle, they learned from previous downturns that when you have the motor stop for the capital markets and companies are not able to finance themselves, those that had sound balance sheets, when their revenues are cut to zero, those balance sheets don't look so sound anymore. They can't earn enough money to pay back those debt obligations. They needed liquidity, but it's very troubling for investors like ourselves or anyone else to lend them new money because we're uncertain of when will this end. We didn't know a lot. We didn't know about the healthcare outcome. So that would have been very difficult. But when the Fed put in that floor, capital markets opened. We've seen, just in the case of the high yield market, I believe over 100 billion of new issuance just in the last couple of months. So it's an incredible amount of funding that was not seen in the fourth quarter of 18, certainly in the second half in early 2008 and the early 2009. Capital markets were shut down. So we can point to many industries that were hard hit, that we're not getting the revenue and they're still down materially. And you know those sectors, whether it be travel and leisure or retail focused, many of those sound operators were given that more than lifeline. They were fully funding capital for the next year or two. And here they are, in many cases, they're already operating and taking bookings today. So they're actually financed at a better level than they might have been in the past. So keeping an eye on time, because you know I like to get excited about these things. What that links directly into is a question about defaults and should defaults rise from here. We have already seen defaults. We have already seen companies that cannot meet their obligations file. It's important to remember that the occurrence of defaults and the markets are not correlated, meaning when defaults peak, that's not when the equity markets bottom. When defaults peak, the equity markets have already re-ramped back up. Spreads are tightening. Things are moving into the better part of the economic cycle because there is a lag of as much as 12 to 18 months from the announcement of we're having trouble to actually filing for default. Some of them come quicker, but every cycle has pointed to that. And the only time that didn't happen was the double turn in the early 2000s when it looked like we might be rebounding in 2002, and that didn't happen until 2003. There were a lot of factors I'm not going to go into today of what the recession of 2000, 2001, and 2002 was. The methodology and components were very different than they are today. So we are not looking for that. So risk asset market participation, thinking about when rates are falling and rates are rising. As we are not looking at a rising rate environment in the near term, this is a standard slide, but this is not something we'd be forecasting or concerned about today. But should rates rise, income and growth is definitely a good place to be. Market yields, we talked about this a few moments ago, very difficult to get income. Only the first 3 bars are going to give you anything that's mid-single digit or better. So when you look around the world and the opportunity set of where you might get your income, that's difficult to come by, and that's why other solutions are necessary today.
Allianz Global Investors.